Hey guys, this is George David with George David Investing, and in today's video we're going to be talking about Walgreens stock and how Walgreens has a nice 5–10% upside potential in the short term, especially as the stock is being undervalued and has positive earnings momentum. As always, we're going to be also breaking down the stock market as a whole today and seeing any triggers for a potential stock market crash down the road. Definitely don't want to miss it. But let's go ahead and dive right in to analyze Walgreens stock. Okay, so in this video, we're going to be talking about number one, Walgreens stock analysis. Additionally, we're also going to be covering, as always, number two, today's stock market news. Number three, we're going to answer the question, is it time to buy, sell, or wait, both from a short-term perspective and also a long-term perspective. And Walgreens is really interesting there. And finally, triggers for a stock market crash. So let's dive right into the content. Now, currently Walgreens, apologize for saying that, Walgreens does $33 billion a year in revenue. Now, Walgreens' maximum revenue potential is approximately $50 billion per year. This gives us a growth multiplier of 52%, which means that Walgreens in the long term is only an okay investment. Now, it's a little bit different with Walgreens. You're not going to want to miss my analysis on that in the short term as a short-term play. But as a long-term investment play, Walgreens is an okay, because there is some upside. Walgreens has been undervalued, so you can get a better price right now if you want to do a long-term investment with Walgreens. However, the problem is, quantitatively speaking, the company doesn't really have too much upside. That's 52%. Revenues fluctuate a little bit, so you have a little bit more up and down in your portfolio if you have Walgreens in there. Although, because Walgreens has been undervalued, especially where you have tech companies soaring ever since the COVID stimulus started coming in March and April of 2020. So Walgreens is an okay investment. There's other companies with much more stable revenue growth and future growth potential. Even like an Amazon has bigger revenue growth potential, even though it's such a large company and has consistently stable revenue. So with that in mind, long term, Walgreens is just an okay, but we're going to be touching upon the short-term potential of Walgreens in just a moment. And then finally, wrapping up these four very important questions, is Walgreens a mass use stock? This just kind of helps us hedge any kind of risk, so you don't have an investment, you don't know what you're investing in, or is like Enron, right? Is it something that you would personally use? Do a lot of people use the product, service, or company? And the answer is yes. A lot of people use Walgreens. You might use Walgreens. It is a mass use stock. Now, moving ahead here in today's stock market news, until there's a new news story that starts coming out, we're going to have to dwell upon the last week. And this is the really cool thing with looking at the stock market as a whole. Once you start to understand the trigger points, you can see what's noise and what's actual facts and actual things that could stimulate different responses in the market. So at the moment, we don't have a specific news story outside of COVID lockdowns and all this stuff. So the two big ones here is, number one, corporate tax rate increases. Again, 28% is the desired goal. The consensus estimate is that corporate tax rates will increase to 25%, and currently they're at 21%. This all tangibly impacts Walgreens' future potential and other companies as well, so you don't want to miss that analysis in just a moment. And also, Russia's sanctions, and this is a big one, as I mentioned in the previous videos, because there's consequences to Russia's retaliation on sanctions, as what Ray Dalio likes to call like a second or third order consequence. down the road. So we're going to touch upon that and how that tangibly not only affects Walgreens stock, but any stock in general, because that could be a tipping point to a stock market crash. I'm going to talk about that in just a moment. Now, is it time to buy, sell, or wait? So with Walgreens, right now, if you're looking for a long-term investment, Walgreens is undervalued, but it is not the right time to buy into the company long term. Again, let's take a look at the stock market as a whole. It's been roaring since its buy point, which is that golden cross point in late May, early June of 2020. So right now, we don't know if we're at a bubble or not, and I'm going to show what that means on the next slide. But in the short term, Walgreens actually is a great stock to buy if you're looking for a short-term play with about 5–10% upside just to make a couple extra dollars there. But Walgreens is a terrific opportunity. And that's because the company is completely undervalued. It hasn't experienced the same kind of growth that other companies had with this stock market surge that you can see in this graph here since 2020. In fact, it's trading significantly undervalued, and there's a lot of positive momentum. The stores are opening in new places, people are spending more, people are going out more with the lockdowns receding, and more COVID vaccinations. So in the short term, only positive momentum there. The stock hasn't even caught up to the growth potential it has previously. So again, in the short term, it is a tremendously good time to jump in, buy, make some extra dollars. But if you're looking at a long term, that's a whole different way of perceiving things. You want to wait there, because as I talk about in the next slide, this might be the issue of investing at the wrong point in the long term. As always, you don't want to buy a dip in the long term and then sell when things get a little bit hairy. So basically what happened here is if you bought at this dip, this perceived dip in March of 2000, you sold there in October or September of 2000, you would have dropped down significantly in the amount of money you have. In fact, just to recover that cost would have taken you about like 8 years. So that's why it's really important to always buy, as I emphasize, at the golden cross point. You can see here, this came in September of 99. And if you held for a year and a half, you would have made a nice 30 to 40%. If you wanted to hold the security for about 10 years, then you would have made infinitely much more, I think over 200% on that investment. So as always, if you're looking for long-term investments, wait for the golden cross point, whether it's in the stock or in the stock market as a whole. We are not there yet. Now, let's talk about triggers for a stock market crash. As always, it's super important to understand what's going on in the market so you don't invest, especially long-term, at the right point at the wrong point in time. And the triggers, again, what I say is, number one, it's higher interest rates. When interest rates start getting higher, businesses can't take out as many loans because their interest payments gets higher. And this starts to slow down the amount of businesses that can hire additional people or take out additional expenses. This higher interest rates slow spending. The higher interest rates itself is not an issue. The issue is when oil prices start spiking. Right now we do have higher oil prices. Also, there's a thought that inflation is heating up faster than expected, so the Fed might have to start considering hiking up interest rates before their possible target of 2023. And we've seen that number reflected in the producer price index coming out at 4% inflation year over year in March, which was really interesting. I think personally, we're going to see higher interest rates come in a little bit faster than expected, maybe 2022. And that means we're about a year out from that. But spiking oil prices, that's really the nail in the coffin, because where the Fed can react in real time with interest rates, it can't necessarily do that with spiking oil prices. If oil prices start spiking up, number one, corporations and businesses can't pass on that cost easily to customers via cost push inflation. It's not easy to digest. This causes a spending shock. People don't spend as much money, but also oil permeates to every aspect of the economy. If in everyday life, spending more on oil means that you're spending more on oil and cutting down expenses in other areas. If you're a business, that means your inputs for goods and services, those are going up. So that means prices are going up. People are spending less for those goods and stuff like that. So it really is something that touches everything. Businesses, in short, spend less, people spend less. Obviously, another wild card trigger that we do have to watch, and I think I'm going to put this on my next video, is the pandemic lockdown. There's been some talk about the variant being a lot worse, and personally, I've heard stories of people actually dying from the variant. I think this might be an underreported thing, but if there's another lockdown in the economy because of the pandemic or something like that happens, I don't think the market yet has priced that in, and that's going to cause a shock. So I'm going to be starting to talk about that a little bit more in the future videos. But if there is another lockdown via a variant that gets out of hand or some kind of new pandemic, well, that's a spending shock as well. And once there's a spending shock, that also triggers a stock market crash as well. So let's understand how that breaks down for Walgreens stock. So obviously, number one, Russia, although we don't do too much business with Russia, the problem here is that Russia retaliating and cutting back oil supply will increase oil prices. This means that the countries internationally we do a lot of business with, such as the European nation states, also China, are going to have higher oil prices. That means those people are going to be spending less on goods and services, especially big businesses that do a lot of business from the United States, such as Apple in China and in Europe. That means spending gets impacted there. That impacts earnings. And there you go. Once a couple of large entities start having to revise earnings guidance and those kind of things, that's when you start having a stock market crash. This starts permeating to the economy as a whole. Number two, corporate tax rate increases. This will cause a correction in the market, but it will not cause a stock market crash because this is basically an earnings adjustment. Earnings are going to get lower. Companies are going to have to revise there, but ultimately, since an increase in corporate tax rates is basically an accounting line item, you're not going to have that really impact GDP. And because of that, businesses can continue to spend and hire people. More people means more spending in the economy. So corporate tax rate increases. Since it's a little bit of a jump, that's not going to be that bad of a problem that as many people think. So as always, go ahead and smash that like button if you really enjoy this content, just like you would smash higher oil prices out of frustration. And if you haven't done so already, please subscribe to the channel. Not only will it help grow this content, but it'll help notify you of any time that I come out with another video I try to post daily. All right, guys, until the next one, have a good one.